Welcome to Mark Trade's Volatility for the week of July 12th, 2026. In geopolitical news to watch this week, the ever-flaring U.S.-Iranian conflict with U.S. airstrikes and a revoked oil waiver, low international oil reserves. Any escalation towards closing the Strait of Hormuz could cause random price jumps. A fragile inflation picture. Inflation expectations have risen. Traders are pricing in a real chance of rate hikes. The upcoming Fed leadership transition. A move away from forward guidance may increase volatility. The pre-midterm soap opera is in full swing, and political intrigue may push market expectations around. In late-breaking news, we now have one, maybe two Republican senators have recently passed away. That's going to change the narrative for the next few weeks. Worth noting, markets have shown a pattern of sharp risk-off moves followed by quick recoveries. Current market regime. The current market regime looks like a low volatility bull market under geopolitical stress testing. The VIX is sitting around 16. Oil-driven inflation fears and Iranian headlines periodically jolt the tape. Dips are still being bought rather than triggering a sell-off regime shift. Beneath the surface, there's real rotation. The tension to watch is whether this rotation is a healthy broadening or an early echo from the dot-com era. History seldom repeats itself, but it often rhymes. Volatility environment. Spot VIX is around 16, but the short-term structure is in the longer-term structure is in contango. Markets are pricing meaningfully more turbulence over the next few months, largely on the back of the Iranian oil overhang and Fed hike pricing risk. Elevated skew signals rich pricing for tail risk. Hedging demand, not complacency, is driving flows. A Strait of Hormuz escalation or a hawkish Fed surprise could cause vol to jump sharply rather than drift. In this potentially rising vol environment, I'm looking for equities not directly affected by these risk factors, keeping powder dry to take advantage of any vol spikes, only opening short-term options in stocks I'm willing to hold through a violent move. Current market narrative. Three narratives are competing for investor attention. The AI capex versus valuation debate. Recent wobbles in chip names have shown growing unease. Optimism might already be fully priced. The top 10 S&P names now represent 40% of the index. Echoes of 1999 are growing louder in the conversations. Second is the geopolitical versus inflation narrative. The simmering Iranian conflict. Are oil spikes one-off events or the start of a stickier inflation problem? Fed hike versus cut bets for the second half of the year are driven by oil, geopolitics, and U.S. midterms. Third is a domestic policy affordability thread. Trump's America First populist proposals alongside the upcoming Fed leadership transition and midterm elections are adding a layer of political uncertainty that's less about geopolitics and more about U.S. regulatory and monetary policy direction. Underlying all three of these is a kind of narrative fatigue. Markets are growing immune to the on-off Iranian headlines. Markets' attention could pivot quickly towards earnings season, inflation, or any other news story. Upcoming economic releases. Monday, the U.S. monthly budget report is not likely going to move the market. Tuesday, core inflation rate and Federal Reserve Chair Kevin Walsh's testimony could trigger renewed future interest rate posturing. Wednesday, PPI month over month might build on any Tuesday-inspired inflation concerns. Thursday, retail sales month over month. I'm not expecting any surprises. Friday, building permits, housing starts, and Michigan consumer sentiment might exaggerate any moves sparked earlier in this week. It is the beginning of earnings season with a ton of banks and AI tech companies. So, upcoming earnings. Monday, FB Financial Corporation, FBK, and Group Aeromax, AREO. It's relatively quiet Monday. Tuesday's a big one for banks. JPM, JP Morgan, BAC, Bank of America, JS, Goldman Sachs, WFC, Wells Fargo and Company, Citigroup, FAST, Fastenal Company, ERIC, Telephonic, blah, 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 Ericsson, AEHR Test Systems, KMTS, Kestrel Medical Technologies, WINA, Winmark Corporation, PXED, Phoenix Education Partners, amongst a bunch others. Wednesday, ASML Holdings, J&J, Johnson & Johnson, MS, Morgan Stanley, BLK, BlackRock, PGR, the Progressive Corporation, BNY, the Bank of New York Mellon Corporation, PNC, the PNC Financial Services Group, ELV, Elevance Health, CTAS, Cintas Corporation, KMI, Kinder Morgan, UAL, United Airlines, and many others. Thursday, TSM, Taiwan Semiconductor Manufacturing, UNH, United Health Group, GE Aerospace. This one's to watch with a lot of positive news, might be more volatile than normal. NFLX, Netflix, ABT, Abbott Laboratories, ISRG, Intuitive Surgical, PLD, Prologis, USB, US Bancorp, SST, State Street Corporation, CFG, Citizens Financial Group, WIT, Wipro Limited, AA, Alcor, and many others. Friday, TRV, the Travelers Companies, TFC, Truist Financial, FITB, Fifth Third Bancorp, DNSKF, Danske Bank, RF, Regions Financial Corporation, YRAIF, Yara International, ALV, Autoliv. High volatility stocks worth looking at. Interesting $10 to $50 stocks. These tend to be very high risk trades dominated by binary events rather than broad market trends. You should have a strong fundamental or directional opinion before placing volatility trades in this price range. MapLight Therapeutics, MPLT, traded at $39.32 on Friday with an IV of 313, an IVR of 99, and an IVP of 100. MapLight Therapeutics is a clinical stage biopharmaceutical company developing novel therapeutics for brain disorders, including treatments for schizophrenia and autism spectrum disorder. Its leading programs use platforms like optogenetics, transcriptomics, and StarMap to identify and target neural circuits linked to CNS disease. Reasons it might rise. Analysts remain bullish on the name heading into key catalysts. Shares are already up 113% year to date, showing strong momentum and investor appetite for the story. A phase 2 readout for its lead schizophrenia candidate is expected mid-August, and continued positive trial news could extend the rally. Reasons it might fall. The IRIS trial for its autism candidate recently missed its primary endpoint, showing the pipeline carries real binary trial risk. The company recently named an interim CFO following an HR review, which can sometimes signal internal disruption. Valuation now leans heavily on the upcoming Zephyr trial readout, so any disappointing data could hit sentiment hard, and one analyst has only a hold rating given this binary risk. Caveats. This is a volatile story pipeline-driven biotech with a single trial readout, expected mid-August, that can move the stock dramatically in either direction. The upcoming 30-day window may not capture that catalyst. If you've got an August trade on and the news gets pushed out to September, the volatility will stay up, but the price might not move. But if it comes in as expected, August's going to be after that event. August's options are going to be after that event. Trade ideas. With the cart holding up, looking at the August puts, with the chart holding up, look at the August puts. In the July expiry, you can sell puts $5 below at the money for serious premium. Just remember, with an IV of 300, it is not because it's a safe play. 10x Therapeutics. 10x Therapeutics recently closed at $17.54. It's got an IV of 289, an IVR of 91, and an IVP of 99. 10x Therapeutics is a development stage pharmaceutical company developing novel cardiopulmonary therapies, including oral and IV, I'm not going to say that, formulations for pulmonary hypertension and heart failure. Reasons it might rise. Cash was 97 million at the end of 2025, expected to fund operations through 2027, reducing near-term dilution pressure. The company recently achieved its randomized target of 230 patients in the phase 3 level study and secured a long-term supply chain deal for levosimendan, both supportive milestones. I'm not even going to try and pronounce that, but things are coming together for it. The stock carries a buy rating with a $20 price target from at least one analyst, and multiple firms have raised targets earlier this year into the $40 to $50 range. Reasons it might fall. Seeking Alpha downgraded the stock from buy to a hold ahead of major phase 3 level data readout expected in August, and a trial failure could cut shares by 50% or more. Tip ranks AI analyst rates it neutral, citing weak financial performance, no revenue, expanding losses, and heavy cash burn, and weak technical momentum, including trading below its key moving averages with a negative MACD. A $300 million self-registration remains in place that the company could use, creating ongoing dilution risk. Caveats. Top-line phase 3 data is expected mid-August 2026, just after this August window, this August options window closes, but pre-data positioning and any leaked interim commentary could still cause volatility. Trade ideas. Debit put spread in the 20 delta range in August or September, if you can get a good price, could express a bearish sentiment. And if you're a bullish, a July at the money will pay handsomely. August even more. August $10 puts are not very liquid, but around $2.70. Next up is Siona, S-I-O-N, closing Friday at 45.29 with an IV of 213, an IVR of 97, and an IVP of 100. Siona Therapeutics is a clinical stage biopharmaceutical company researching and developing medicines for the treatment of cystic fibrosis, with a pipeline of CFTR correctors and stabilizers, including candidates that have completed phase 1 and phase 2 trials. Reasons it might rise. 3 analysts rate the stock a strong buy and 7 rate it buy, with price targets as high as 63. That's quite an up 50% up almost. Siona recently completed enrollment on its Precision CF phase 2A trial involving a potential clinical catalyst. Institutional interest has been building. Reasons it might fall. The company missed Q1 earnings estimates, reporting a 60-cent earnings per share loss versus a consensus estimate of 52-cent loss. There have been persistent insider selling, including director selling roughly 85,000 shares in early July, and one of its affiliates selling 115,000 shares, both under 10b5-1 plans. Freedom Capital downgraded the stock from a strong buy to a hold, and Wall Street Zen cut it from a hold to a sell, showing some analyst caution alongside the bullish majority. Caveats. A pre-revenue clinical stage biotech with a beta of 1.33 and a wide analyst's target range from 53 to 63. Expect above average volatility tied to trial updates and insider transaction headlines. Trade ideas. The charts are strong. I'm leery of upside before any announcements. Perhaps selling a July or August at the money put if you can get out at 25% max profit on a price pullback. Next one, USANA. Sorry. The symbol is USNA. The company is USANA Health Sciences. Recent price of $21.98, an IV of 90, an IVR of 33, an IVP of 65. USANA Health Sciences is a direct selling company that develops, manufactures, and sells science-based nutritional, personal health, skincare products across Asia Pacific, the Americas, and Europe, operating through its legacy MLM business and newer consumer brands like Haya and Rise Wellness. Reasons it might rise. USNA trades at a significant valuation discount of EV/EBITDA of EV over EBITDA of 2.67, with a projected 2026 price target about 25% above current levels, and the company is expanding fast-growing brands like Haya and Rise Wellness. Rise Wellness's Protein Pop Plus recently launched at all 607 Costco locations nationwide, a meaningful retail distribution win. Q1 2026 revenues and earnings per share both beat analyst estimates, and the company reiterated full-year guidance. Reasons it might fall. Technical indicators are weak. 17 technical indicators show 3 buy, 11 sell, 3 neutral, and characterizing the stock as a strong sell on a short-term basis with a 30-day analyst forecast skewing negative. Company insiders have been net sellers, disposing of about 1.9 million or more shares and that they bought over the last 12 months. Q1 net income fell 20% year over year, and profit margin narrowed to 3% from 3.8%, showing pressure on the core declining LLM business even as new brands grow. Caveats. Long-range price forecasts for the stock vary enormously across models, from single digits to over $400 by 2050, reflecting low analyst coverage and high forecast uncertainty. Trade ideas. If you like the story, sell at the money puts and then calls above your entry, holding till it maybe takes off. Selling at the money puts and then maybe buying calls above your entry, holding till it takes off. Next one, we have Chicago Atlantic Real Estate Finance. Last trading at 1082 with an IV of 28, an IVR of 31, an IVP of 78. Chicago Atlantic Real Estate Finance is a commercial mortgage REIT that originates, structures, and invests in first mortgage loans and alternative structured financing secured by commercial real estate, with a loan portfolio comprising of senior loans to state-licensed cannabis operators. Reasons it might rise. Chicago Atlantic entered a definitive all-stock merger agreement with affiliated BDC Chicago Atlantic in June 2026, aiming to streamline management, reduce operating costs, and create a larger combined platform worth an estimated $771 million. 100% of the portfolio is protected by fixed rates or floating rates with floors at or above the prime rate, giving consistent protected yield. The company has kept its portfolio relatively insulated from broader private credit market pressure by sourcing shorter duration, non-broadly marketed loans, and continues paying a steady 47-cent per quarter dividend. Reasons it might fall. Q1 2026 net income declined to about 4.8 million from 10 million a year earlier, driven largely by a 3.8 million provision for expected credit losses in its cannabis lending book. The stock is trading near the bottom of its 52-week range and below its 200-day moving average. The pending merger with Lean introduces, Lean being the symbol, LIEN, introduces integration and execution risk, and any delays or shareholder pushback could weigh on the stock. Caveats. This is a cannabis leading focused micro small cap REIT. It carries concentrated sector risk, state legal cannabis operators, and is currently in the midst of a merger process, both of which could add event-driven volatility beyond normal REIT price action. Trade ideas. The chart seems to imply a $10 floor, but with prices away from the strikes, I think you would be looking at selling an August 1250 put and either selling at 50% max profit or taking position and selling calls or the underlying to get out. There's enough extrinsic value to support some interesting plays, but be aware you might end up being assigned. If the price moves significantly down, I can see naked $10 puts making sense. Next. Interesting $50 to $100 symbols. Symbols with high IV in this price range tend to be strong companies with strong news or narrative events pushing price and elevated IV. For naked short trades, be sure you are comfortable managing the trade or taking possession of the underlying for extended periods. So the first one is GenDX Holdings, WGS. Last traded at 65.90 with an IV of 90, IVR of 37, IVP of 86. GenDX is... let me put that up to a year so you can see a whole year. Thank you. GenDX is a genomics company focused on pediatric and rare disease diagnosis. diagnostics, primarily through whole exome and genome sequencing, alongside an AI-driven platform for clinical interpretation and reporting. Reasons it might rise. Wall Street consensus remains strong buy, with an average 12-month target well above the current price. Volume growth of 34% year over year continues even though revenue growth has lagged. A new president, Mark Gardner, was appointed effective June 15th, 2026, which could lead to a positive catalyst if the market views this as a strengthening execution. Reasons it might fall. Multiple analysts have cut price targets recently, setting more conservative assumptions on revenue growth and margins, with one major cut from 155 to 75. The company lowered its 2026 to 2028 guidance, and it will take time for new testing capabilities to drive growth. The stock has been extremely volatile in 2026, down over 50% year to date, and at one point before a sharp rebound. So it's prone to large swings on any incremental news. Caveats. Small mid-cap, high beta name. Consensus is bullish, but price targets vary wildly, reflecting real disagreement among analysts. Trade ideas. 30 delta short put, 60-day long call spread, monthly wheel. And TIGO, Millicom International Cellular. So, last price of $96.96, an IV of 59, IVR of 86, and an IVP of 100. Millicom, operating under the Tigo brand, provides mobile, broadband, and pay TV services across Latin America and previously Africa, serving roughly 60 million wireless customers across 9 countries. Reasons it might rise. New management since 2023 has driven an aggressive cost-cutting program that has meaningfully improved profitability and cash flow without hurting revenue. The company is now applying similar cost discipline to newly acquired Latin American assets from Telefonica. Shares are trading near their 52-week high and with a healthy dividend yield of around 3.2%. The stock has had strong 12-month momentum, up from the mid-30s to the mid-90s. Some models put a 12-month target near 95 with an optimistic case near 100, implying room to grind higher if execution stays on track. Reasons it might fall. Insiders sold roughly 8.2 million in shares over the past 3 months with no offset buying. By some valuation models, the stock looks significantly overvalued relative to intrinsic value estimates. Wall Street sentiment is definitely mixed. A conservative downside scenario puts the stock much lower over the next year if earnings disappoint or competitive FX pressures in Latin America intensify. Caveats. Emerging market telephone exposure brings added currency and political risk on top of normal equity risk. The stock has already had a huge 12-month run, which raises the bar for continued upside. Trade ideas. At the money debit call spread, 45 DTE, 30 delta short put or put spread. Both look interesting. Latin America seems to be moving more towards the right, which might support more corporate optimism. Next, we have CNC, Centine Corporation, at $67 last Friday. An IV of 57, an IVR of 59, and an IVP of 76. Centine is a major managed care organization providing government-sponsored health insurance, Medicare, Medicaid, and ACA marketplace plans to roughly 20 million members across the U.S. Reasons it might rise. Multiple analysts have recently raised price targets following supportive commentary, and the current health care exchange environment is favorable for Centene. Q1 2026 results were strong enough that management raised full-year adjusted earnings per share guidance above $3.40, with Medicaid margins improving. The stock has already rallied 66% year to date, suggesting continued institutional support. Reasons it might fall. Continued concerns around weaker ACA marketplace enrollment, concentrating risk in the existing member base. Marketplace business faces an $8 billion revenue headwind in 2026 from expiring enhanced subsidies, structural challenges, even if partially priced into guidance. Insiders have been net sellers with no offsetting buying reported. Caveats. Managed care remains sensitive to regulatory political headlines, Medicaid redeterminations, ACA subsidy policy, DOJ scrutiny of the sector. So news-driven volatility is elevated. Trade ideas. 45 to 60 days. Sell the put spread around 30 delta with a cheaper debit spread. With a cheaper debit put spread below that in case of a major new volatility. Monthly wheel. Short weekly puts with 30% take profit target. Next one, TPC. Tudor Perini Corporation. Closed Friday at 75.89, has an IV of 67, has an IVR of 75, and an IVP of 83. Tudor Perini is a diversified construction company operating through civil building and specialist contractor segments, focused on large-scale infrastructure, transit, government, and commercial projects in the U.S. Reasons it might rise. The stock has recently drawn strong buy upgrades and higher earnings estimates, supported by robust infrastructure demand and a record backlog of $21 billion, up 102% year over year. One widely followed valuation narrative puts fair value at $113 versus a recent close of $76.75, Friday being $75.89, implying meaningful upside if the market re-rates the stock towards the analyst model targets. The company recently redeemed $400 million of its 11.875 senior notes, and it has continued to secure large new contract wins: Midtown Bus Terminal, transit corridors, Indo-Pacific defense work, and reinforcing multi-year revenue viability. Reasons it might fall. The stock recently moved negative 3.47 in a single session over a broad, even as broad indices were mixed to higher, showing swing violently on its own news momentum. Some value models see the stock looking significantly overvalued, with a current PE far above its 5-year median, and insiders sold $2 million in shares over the past 3 months with no buying reported. The company's reliance on a handful of mega public projects, along with exposure to cost overruns and litigation, is flagged as a key risk to the bullish backlog thesis. Caveats: construction and infrastructure names carry project execution and litigation risk that can cause abrupt moves unrelated to the broader market direction. The stock has a very wide 52-week range of 43 through 100. Trade ideas: 45-day DTE, 30 delta short puts with a 50% take profit and roll at 21 DTE, and wheels both weekly and monthly. And then BXC, Blue Line Holdings, closed Friday 54.17 with an IV of 77, an IVR of 86, and an IVP of 99. Blue Links is a wholesale distributor of residential and commercial building products across the U.S., selling structural products, lumber, plywood, OSB, and specialty products, engineered wood, siding, and millwork to home centers, pro dealers, and industrial customers. Reasons it might rise. Analysts hold a bias consensus rating with a price target well above recent trading levels. The company has previously shown upward revisions to earnings per share and EBITDA estimates on strong operating performance, alongside strategic investments in job site delivery equipment aimed at driving sales. Shares have pulled back significantly from their 52-week high of $88, which could set up a mean reversion bounce if building products demand stabilizes. Reasons it might fall. The company has also recorded its lowest second quarter EBITDA margin since 2018, pointing to declining profitability trend that raises concerns about financial health. A separate recent price target of $55 implies downside risk. The stock trades at an elevated normalized PE of over 120 and has a wide 52-week range of 44.90 through 88.56, reflecting sensitivity to housing construction cycle swings and input cost volatility. Caveats: building products distributors are highly cyclical and tied to housing starts, mortgage rates, and lumber OSB commodity pricing, all of which can move the stock quickly regardless of the company's specific news. Analyst coverage here is thin, so price targets carry less statistical weight than for more widely covered names. Trade ideas: $45 puts are about the bottom of a recent $45 to $65 trading range and have decent extrinsic value. Short puts, put spreads, or even wheels at $45 or $50 are interesting, depending on early week moves. Interesting $100 plus symbols. Symbols with high IV in this price range tend to be strong companies with strong news or narrative events pushing prices and elevated IV. For naked short trades, be sure you are comfortable managing the trade or taking possession of the underlying for extended periods in case of outsized moves. Covered calls and potential dividends may continue to offer profits while prices recover. AKAM, Acme Technologies, traded Friday at 125.70 with an IV of 81 and an IVR of 94 and an IVP of 100. Akamai provides content delivery network CDNs, cybersecurity, and cloud computing services globally. It has increasingly pivoted towards AI-related security and cloud infrastructure products. Reasons it might rise. Analysts hold a moderate buy consensus, with several firms sharply raising price targets. Momentum is building around AI security initiatives. Akamai completed its $200 million Layer X, adding a secure enterprise browser and AI usage control platform, and launched a unified agentic framework, which immediately boosted shares by over 2%. Technical indicators are signaling a strong buy, and shares have bounced sharply off of a recent pullback into the low 120s. Reasons it might fall. Current RSI indicates the stock is currently overbought. A contrarian forecaster is calling for an 8% decrease from current levels after the sharp run-up. Akamai still faces competitive pressure in its core CDN business as demand shifts toward hyperscalers. Heavy cloud computing investments could limit near-term earnings per share and cash flow. Caveats. Q2 earnings land on August 6th, so results and guidance could easily override any technical setups. This is mid-range. If you have a fundamental opinion, great. I would be trading short, put, or call spreads. I don't think I would want anything naked in this market. Next one is WST, West Pharmaceutical Services. Closed Friday at 353.76, has an IV of 46, an IVR of 60, and an IVP of 76. West Pharmaceutical designs and manufactures containment and delivery systems, stoppers, seals, pre-filled syringe components, wearable injectors for injectable drugs, and biologics, serving pharma and biotech customers worldwide. Reasons it might rise. Analyst sentiment is strongly positive. About 75% of covering analysts rated as a buy, and several firms have recently lifted targets. Barclays upgraded the stock to overweight, citing material upside to estimates, and shares are up over 6% over the past week and 16% the past month, showing solid momentum into earnings. Reasons it might fall. Valuation looks stretched. The stock trades at a more than double its fair PE multiple implied by one model, and it passes 0 of 6 standard value tests, meaning it's priced for continued strong execution. The quantitative models actually project near-term declines, and recent insider executive selling has been noted alongside the stock's rich post-rally valuation. Caveats. Q2 earnings are due July 23rd, squarely in the middle of this options window. A miss or beat on guidance change is likely to be a dominant driver. Trade ideas. I would think that August put spreads 30 delta would make sense. With the volatility, it just looks so good. Call spreads might make sense also. Short call spreads might make sense also. And again, it's sort of about 30 delta. Next is DVita. Closed Friday at 235, has an IV of 44, an IVR of 74, and an IVP of 94. DaVita is the largest U.S. provider of kidney dialysis services, operating over 3,000 facilities and serving roughly 280,000 patients annually, with Berkshire Hathaway owning approximately 45% of the company. Reasons it might rise. DaVita beat Q1 estimates and raised its full-year adjusted earnings per share guidance, driven by higher treatment volumes, improved production, and technology investments, with additional volume expected from competitor clinic closures. Sell-side sentiment is improving, with targets around or slightly higher than the current valuations. The stock is trading near the top of its 52-week range and above its 200-day moving average, reflecting strong recent momentum. Excuse me. Reasons it might fall. Valuation looks extended after the rally. Analyst price targets are mixed and in some cases below the current price. DaVita's business remains heavily exposed to government reimbursement. Roughly 2/3 of U.S. sales come from Medicare. So any policy shift on reimbursements rates or insurance coverage could pressure profitability. And the expansion of obesity drugs poses a long-term risk to the dialysis patient population. Good for the patient, bad for the business. Current trade ideas. Current prices might hold or rise slowly. Short call spreads, not my thing, but a rolling 45-day naked short calls looks like it could harvest good premium. Yeah, I kind of like the stock, but I don't think it's going much higher, and I think the risk is to the downside is sort of what I'm getting at there. Next one, HII, Huntington Ingalls Industries. Closed Friday at 286, has an IV of 44, an IVR of 76, and an IVP of 82. HII is America's largest independent military shipbuilder, building and maintaining U.S. aircraft carriers, submarines, surface combatants, and amphibious ships from the U.S. Navy and Coast Guard, plus mission technologies and unmanned maritime systems. Reasons it might rise. Steady contract flow continues. Recently awarded an option 1-year production contract for the Navy's next generation unmanned systems. And the overall analyst consensus remains buy with a 12-month average target of 381, well above current levels. Defense sector tailwinds persist. Strait of Hormuz, Russia. Navy budgets remain a source of demand visibility, and management is focused on increasing throughput towards a sustainable 6% revenue growth outlook, with margin improvements expected as higher margin ships are delivered. Reasons it might fall. Recent analyst actions have trimmed targets, but they're still above current prices. Technicals look weak. The 50-day moving average crossed below the 200-day moving average, and momentum indicators fell below zero. The stock is trading near the bottom of its 52-week range and below its 200-day moving average, and the company's historically unstable profits have led to significant downturns. Caveats. Next earnings are due July 30th. Guidance and margin and delivery schedules will likely move the stock. Trade ideas. Well, with Trump pushing for more U.S. shipbuilding and the chart patterns, this could be the end of the downward slope. Short 30 delta 40-day, 45-day puts rotating 21 days before expiration. Short July puts, monthly at the money wheels, could all perform well. And lastly, TFX, Telephonics Incorporated. Closed Friday at 135, has an IV of 38, an IVR of 57, and an IVP of 69. Teleflex designs and manufactures single-use medical devices for critical care and surgical applications, including vascular access catheters, interventional cardiology products, and surgical instruments sold to hospitals worldwide. Reasons it might rise. Sell-side sentiment has turned more positive recently, with targets slightly above the current price. Q1 revenue beats expectations, with a new CEO taking over and restructuring divestitures on track. The stock shows a bullish technical structure, trading above key moving averages, and it currently sits near the top of its 52-week range, with the 50 and 200-day moving averages both trending positively. Reasons it might fall. Underlying fundamentals remain weak. Sales have fallen over the last 2 years. Earnings per share have been flat for 5 years, and returns on capital are below average. Operating margin has dropped sharply in Q1. Wall Street expects full-year earnings per share to shrink despite revenue growth. Analyst consensus is hold, and the company recently issued $500 million in new senior notes, adding leverage. Caveats. There's an active shareholder litigation investigation tied to the company, which adds headline risk on top of normal earnings-related volatility. Trade ideas. Trading at the higher end of a multi-month range, iron condors, short put or call spreads, and if you have directional opinion, are a viable idea. Summary of the week to come. Earnings season is upon us. Watch for and take advantage of emerging themes and rotations. In breaking news, with 1, maybe 2 deaths in the Republican Senate, U.S. political jockeying is likely to be elevated for these next few weeks. Watch for high volume expansion risks, and good luck in the week to come. Thank you.